The first rule when we are consolidating the statement of financial position is that all our assets and liabilities are subjected to the rule of simple addition. What this means basically is that for all our assets we have to say parent plus subsidiary. It's that simple. That is what we mean by simple addition. So if, for example, you have the parent has, let's call it inventory of 100, while the subsidiary has inventory of 200, then it means that the consolidated inventory is 100 plus 200, which gives you 300. Let's try with something else. Let's try receivables. If the parent has receivables of 50, the subsidiary has receivables of 50, then the consolidated one is 50 plus 50 to give you 100. So that is what we mean by the rule of simple addition. Now, the only exception to that rule has to do with an asset that appears in the parent's books, and that asset is called the investment in a subsidiary. It normally appears in the books of the parent as an asset. Now that asset will cancel out with the subsidiary's equity. So it means that in the consolidated books there will be an item that is in the parent's books that will not appear, and there will be some equity in the subsidiary's books that will not appear. But for all other items we use the rule of simple addition. Let's put our knowledge into practice. We are given here a scenario. We are given two balance sheets or two statements of financial position that are balancing. One of them relates to the parent and another one relates to the subsidiary. We are told that these accounts were prepared on 31st December 2010 and the acquisition date is the same date. So the subsidiary was acquired on the same date and the parent acquired 100% of that subsidiary. We are required to prepare the consolidated statement of financial position. What this means is that my consolidated books will have, if I may just use this space, for PPE you do simple addition, you get PPE is 200. Investment in subsidiary cancels out with the equity of the subsidiary, so this will not appear, but neither will be the equity of the subsidiary, so nothing there. Then we have current assets, simple addition, 100 plus 100 gives you 200, so you get 400. With regards to equity, we have share capital, which only the parent's one is remaining because the subsidiary's one cancelled out. Retained earnings is 100, and then we have liabilities of 100, and we see that our accounts balance at 400. It's that simple. The consolidated accounts must balance. If they don't, then there's an error somewhere. The second rule of consolidation is that when you are cancelling out the cost of the subsidiary against the subsidiary's equity, only the equity that was there on the date of acquisition cancels out. So any post-acquisition equity will not cancel out. It therefore means basically, if I have parent, I have subsidiary, then I'm told that there's a cost of subsidiary is 200, and then on the subsidiary's books we have share capital and retained earnings, let's say of 100 bob there, and retained earnings of 50. For the sake of argument, let's make this one 50. If I'm told, for example, that on the date of acquisition, which was some time back, the retained earnings that were there were not actually 150, but they were 100. This means that if you use a timeline, so the return is currently 150, but on the date of acquisition it was 100. It means that when I'm cancelling out, I'll have to cancel out this 200 against what was present. On the day of acquisition we had a share capital of 100, so it goes. The retained earnings was also 100, so it means that 50 is post acquisition. So this extra 50 that has come about in the post acquisition period is not cancelled out. It will, however, be added to the parent's equity as at acquisition date. Now let's put that concept into practice by looking at a short illustration. So here we are told that the accounts are as of 31st December 2010, but the company was acquired some time ago in January 2010 when the retained earnings were 100. So concept is very clear. This investment in subsidiary 300 will not appear because it will cancel out to the equity. So 200 there and the 100 that was there on the date of acquisition. So this 100, but there will be a carry forward of 20. So that 20 will be subjected to simple addition. Let's now solve for that. So in my consolidated accounts, we will have PPE simple addition 100 plus 200, which gives you 300. Investment in subsidiary has cancelled out, will not appear. And then we have current assets, which is 100 plus 150, which gives you 250. So we have 550. Then under equity we shall have share capital, which it is a parent's one of 300. Then we have retained earnings, which is 100 plus a carried forward of 20, which gives you 120. Then we have liabilities of 100 plus 30, which gives you 130. When you do our simple addition we get 550, and our accounts again balance. Now it is not always the case that the cost of the subsidiary will be equal to the net assets of the subsidiary as at the acquisition date. There will be times when the cost of what we have paid for far exceeds the net assets that we have acquired. The extra amount that we have paid is considered to be goodwill, and that goodwill should appear as an asset. It's very simple. If I may illustrate, just assume we have the parent, we have subsidiary there, then you're told the cost of S is, let's make it 200. Then you're told on the same date when we acquired S had share capital of, let's call it 100, and it had retained earnings of, let's call it 20. So when I'm doing my cancelling out, I'll find out that this is 200, but this one is combined of 120. So this 120 in its entirety disappears, and this one out of the 200, 120 disappears, but there's a carry forward of 80. So this carry forward of 80 becomes goodwill and is capitalized as such. Okay, so let's see that in application by way of an illustration. So we realize that the acquisition date is the same as the balance sheet date. So on the date of acquisition, when I paid 200, I can see that the net assets or equity is 100. So it means that this one cancels out, and out of this one only 100 cancels out. So there's a balance carry forward of 100. That 100 carry forward is considered goodwill and must appear in my consolidated accounts. So it means that in my consolidated SFP, basically I'll have my PPE, which is 200 plus 100, which is 300, and then I will have goodwill, which is 100, so it's giving me 400. Then under equity I'll have share capital 300, then I'll have retained earnings of 100. So again my books are in balance.